Hello everyone, and thanks for tuning into the Financial Investor channel. My name is Brent, and today we're going to be covering our 5 stocks to ex-dividends next week. First, I wanted to discuss the markets, yesterday and today, January 29th and 30th. It's been a bit rocky, but I saw a lot of people, a lot of new investors in a lot of the Facebook groups that I'm in, dividend investors and such. And a lot of them were saying, is this the correction we were looking for? The 5% correction. And it's not. We're down, 1.5% over the last few days. I have the S&P 500 pulled up right here. You can see that's, 1.7%, right around there. The Dow Jones down around a little bit more. So that's nearly 2% on the Dow Jones. And the NASDAQ is down about another 1.5%. But you know what we haven't had in a long time? When I was looking back through the graphs, the S&P 500 hasn't fell by say 2-3% since around August timeframe. I believe it was August 8th was one of the last times I made a video of a pullback that was greater than 2%. Today, over just 2 days, we had a pullback of around 2%, but that's a great opportunity. Plus, we had some news that was announced. We had Amazon, Berkshire Hathaway, JP Morgan announced this morning that they're trying to set up a health company. Amazon had already filed for a patent. I posted that on my Facebook page. There's a little article here, you guys, if you guys would like to just pause the video, read through it. Otherwise, you can go to my website or just look up Amazon, Berkshire, JP Morgan to set up a health company for their staff. But Amazon's already patenting, they're trying to get into that business as well. We've known that for a while, and they also affected some of the big companies, which is why I posted this article here, or my picture here. My AbbVie, my Pfizer, Johnson & Johnson, CVS, a lot of those pharmaceutical companies fell a lot today. AbbVie falling more than 5%, but this just reminds me of the last time that Amazon, they announced that they were buying up Whole Foods. My Lowe's, Costco fell by around 8%, 10%. That was the time I bought Lowe's, I bought Costco after these announcements, and now both of those stocks are nearly up 30%. So definitely, it's recommended to just buy the dip of whatever stocks that you're interested in if they are great for the long term. Again, it's been nearly 5 months since we had a pullback such as this. If you look back to around August 8th through August 13th, we had a pullback right around 3% in that time frame, but then ever since August, we've just been on the run up. We are up 17% since then, and then we had 2% pullback today, so we're still up 15% over just the last 4 months alone. So very nice run up. What else did I post here? Over on my website, I finished my article, released my 5 stocks to ex-dividends next week. I have TMP, which is Tompkins Financial, INTC, which is Intel Corp, SAL, Salisbury Bank Corp, BNTC, Burnmile Bank, and then PAG, which is Penske Automotive. So we're going to be checking that out here in just a minute. Now, if you guys are interested in seeing what takes place after hours, there's 2 places you guys can check this out. If you go over to CNN or just type in after hours, like CNN after hours, it's going to show you here the U.S. stock futures, and a lot of times this is going to show you, the direction that the market's going to be moving tomorrow. S&P is expected, estimated to be moving back up in the green tomorrow. NASDAQ back up in the green tomorrow. Dow Jones back up in the green tomorrow. Will it stay in the green? We'll see. I haven't heard much from the State of the Union address that President Trump's supposed to be doing, so that could sway the markets one way or another. You can also go over to Market Watch and take a look at some of the leaders for the after hours change, some of the most active stocks here. So you can see that Rite Aid, they jumped up nearly 3% after hours. If you go down into the most active, you can see Microsoft is positive again, AT&T negative, Merck is another pharmaceutical company that went down due to the announcement of Amazon and such. And we have Pfizer going back up tomorrow, Bank of America up. So, there was a lot of stocks that got hit. It wasn't just healthcare stocks, pharmaceuticals, biopharmaceuticals and such. It was a lot of stocks there in general, and that was completely fine. So it was just kind of combination of the two, which caused the a bit of a pullback, but that's great buying opportunity, especially for those out there that were looking to get into a stock. This could have potentially got you a great position, especially like an Avi. I haven't seen Avi back at this position in quite a while. Anyways, let's go ahead and begin covering the 5 stocks with ex-dividends next week. So I wrote up on my page 5 stocks February 5th through February 9th. And these are basically screened. I have to fix this, but these are all have a PE ratio less than 25. They all have yields greater than 2.0, and some of them do have increased revenue, net income, and free cash flow over the last 10 years. A few of them do not have positive free cash flow. That's because they did make a couple acquisitions. When I was looking into the stocks, I believe some of the description says that they do quite a bit of acquisition. So we're going to be covering the dividend dates, price comparison to the yield, PE, average, PE to the average of the industry, payout ratio, dividend history, and a few other items. So these 5 stocks are ordered by ex-dividends February 5th through the 9th. The very first one here, we have ticker symbol TMP. Tompkins Financial primarily offers commercial banking services in New York. The company principally engages in generating deposits and originating loans and deposit products, including checking accounts, savings accounts, time deposits, and individual retirement accounts. So their ex-dividend date is the 5th of February, which is Monday, and then you would get paid out 10 days later on the 15th of February. And here we have their graph for the 10-year. You can see their revenue is up nearly 9% average every single year. They're up 98% over the last 10 years. Their free cash flow is down 14.7%, but it's a financial, so money goes in, money goes out pretty quickly. I would look into, their free cash flow a little bit. Why are they going a little bit lower? Why are they below after 10 years? Definitely, that would be something to check out. Net income is up 7% average per year. So overall, pretty good 10-year term. You can see here in 2008, the recession that took place back in 2008. This stock price did fall. It's a free cash flow. I don't have the price included in this one. This isn't a 10-year graph, so I can't show you that 10-year on the price. But scrolling down a bit now, so this stock pays out 48 cents per share every quarter. Their PE ratio is 24.8. They're currently priced at $82.85, and they have a yield of 2.20, 2.31%. So it's about average right now. This stock isn't going up. It's not overpriced. It's not underpriced. I would consider this one fairly, right in the middle. It does have a very high price to book value. I had one of my subscribers mention that you should not buy a financial or banking company, a banking stock, if it has a price to book ratio higher than 1.5. So I still have pages to look and read on that. When charted, it does show that the current stock has a higher price to yield, which would indicate it may be overvalued at this time. The stock is below the industry price to earnings average. It is below 60% payout ratio, and has had dividend growth for the last 32 years. So I would consider this stock very recession proof. Its price to book value is 2.19, which is lower than 3.0, where value investors would consider a value. You can see here over the year, it stayed right around this price to book value of around a 2.0, 2.1. So it's not going up or down. I would definitely do some more research on it. It's not exactly a banking company. They do a financial services in New York, so this one may be a little bit out. Current PE ratio 19.4 to 24.8. You can see that maybe their earnings weren't as high as they expected, so that caused their price in comparison to their earnings to jump up. You can see here they were at a 19.4, so now they're at a 24, so they're definitely over in the industry. So check that out. Dividend yield 2.31, annualized payout is at a 1.92 per share for the entire year. Payout ratio is at 56%. They have dividend growth again, 32 years, and the last time that they increased their dividend was by 2.13, so pretty slow mover there. The second stock is Intel. Intel, as you know, designs and manufactures integrated digital technology platforms. The company offers microprocessors that process system data and controls other devices in the system. Intel's products are used in personal computers, data centers, tablets, smartphones, automobiles, automated factory systems, and medical devices. So they have a range of items that are used throughout different markets. You can see that their revenue is up 6% average per year at 66 over the last 10 years. Free cash flow is up 105%, averaging around 10% per year. And their net income is up 81.42%, averaging around 8% per year. So this is a fairly positive company. You can see their ex-dividend date is right up at the top on the 6th of February, which is Tuesday. You would then get paid out on the 1st of March. Intel is one that has done very nicely lately. Great. They beat their earnings expectations. They beat their revenue and such. So they've done really well. They recently jumped up. And let's go ahead and jump over to their other chart here. So here you can see their spike. They had fallen, hit their support of around $42, $43. They beat their earnings and jumped up into the $48 range. So they did recently have a small hiccup. Remember, I posted this picture on my Facebook site that they were down 2.38%, but look at this run up of where they are now. They used to be nearly at $49. They fell a little bit behind at $48.97. So not a terrible looking stock, but its yield is at one of the lowest positions you would have bought it in, say, the last year. It has a yield of 2.20% and a price to book value now of 3.3. So Intel, when charted, does show that the current stock has a higher price to yield, which may indicate it may be overvalued at this time. The stock is under in the industry price to earnings average. It is sitting below 60% payout ratio and has had dividend growth for the last 3 years. Its price to book value is 3.32, which is higher than 3.0, where value investors would consider a value. So this is shown. I pulled this from MarketWatch, I believe. Let's go stocks and MarketWatch, Morningstar. Okay, so I punched in. This is where I pull my PE ratios from. I go to Morningstar and I get what their PE ratio is. So this is 17.5, and then it shows like the industry average for technology is 27.6. But here, due to their earnings and their current price of they were shot up very high. They're sitting at a PE ratio of 24.73. So they're still below the industry, but it has shot up quite a bit. As of December, November timeframe, this stock was trading at around a 15 price to earnings. Now you're buying it at nearly a 25. So, let's see here. Stock 24.73, industry 27.6. Dividend yield is at around a 2.2, 2.46. They recently increased their dividend. That's not shown here in the graph, but they just announced a dividend increase. Holding the stock, I know that because I'm kind of tracking it myself. Dividend yield is now sitting right around a 2.46 for what you're buying. Annualized payout is at a 1.2, $1.20 per share for the entire year. I think that's the correct one now, because if you take 0.27 and multiply it by 10 or by 4, you get around a $1.10. So we can actually do that really quick. We do bust out the calculator. 0.273 times 4 gets you $1.09, where their new payout is $1.20. So they did increase their dividend there. Payout ratio is very low at 34.3, dividend growth for the last 3 years, and they just increased their dividend by over 10%. So very nice company. If you want the company for the long term, definitely choose to invest in it, but it does look a little bit overpriced at this time. The third stock is ticker symbol SAL. This is Salisbury Bank Corp. It's a bank holding company for Salisbury Bank and Trust Company. The bank is located in Connecticut and chartered in the Federal Deposit Insurance Corporation, the FDIC insured commercial bank. The bank provides commercial banking, consumer financing, retail banking, and trust and wealth advisory services through a network of over 10 banking offices. So their ex-dividend date is on the 8th of February, which is Thursday, and you would then get paid out on the very 1st of March. You can see here their revenue is up 12% averaging per year, or 121% over the last 10 years. Their net income is up 465%, or roughly 46% every single year, and their free cash flow is up 789%, or roughly 78% year over year. So this company right here, it looks like it's on its way up, up, up. So Salisbury here, their PE ratio is at a 20.20. They're currently priced at a 45.05. You can see that this stock goes up and down and up. This one jumps between 45, 48, 45, 48, all the way down into like the $43 range before coming back up into the $47, $48 range, and now coming back down to 45. So very unpredictable. This would have been a great one to swing trade if you're into swing trading dividend stocks. This one has not had a dividend increase since 2008. They've continued to pay out 28 cents per share every single quarter for the last 10 years. Their current yield is at 2.49%, and their price to book value is at a 1.2. So style stock, when charted, it does show that the current stock is a higher price to yield, which would indicate it may be overvalued at this time. The stock is under in the price to earnings average, below 60% payout ratio, dividend growth for 0 years, price to book value of 1.28, which is lower than 3.0, and 1.5 for financial and banking companies, which value investors would consider a value. So the PE ratio 18.9, industry 19.9, dividend yield sits around a 2.49, 2.55 depending on the price of the stock. They pay out $1.12 per share for each share through the entire year, so that's a pretty nice little payout ratio 36.2, and they have not had any dividend growth since 2008. So again, no dividend growth, no dividend increase. They've just continued to pay out 28 cents every single quarter for the last 10 years for each share that you bought. Number 4, we have ticker symbol BMTC, the Bryan Mall Bank Corporation. This is a bank holding company of the Bryan Mall Trust Company. The company and its subsidiaries offer a range of personal and business banking services, consumer and commercial loans, equipment, leasing, mortgages, and a whole bunch of other items there. You can see that they do stuff from tax planning, preparation, and custody, retirement planning and such, and they're located across different states, and they're mainly national. So ex-dividend date is the 2nd of February, which is Friday. You would then get paid out on the 28th of February. So you buy the stock this month, you buy the stock at the beginning of February, you would then get paid out right towards the end. This company, revenue up 18% average year over year, 187% over the last 10 years. Net income up 286% over the last 2 years. They're averaging around 28% per year. So those are good numbers right there. Their revenue and their net income is staying right around the same metric per year over year, and their free cash flow is up 675%, or around 67% average per year. They pay out a 22-cent dividend for every share that you hold each quarter. Their price to book or price to earnings ratio is at a 19.9. Their stock price is $44.98. Their current yield is 1.91, and they have a current price to book value of 2.25. So you can see it did recently increase as of January, beginning of January, maybe end of December. So when charted, it does show the current stock has a higher price to yield, which would indicate it may be overvalued at this time. The stock is at the industry price to earnings average. So the stock is trading at a 19.9 PE. The industry is a 19.9 PE. It stays right around this level over the last year. You can see it stays right around a 18 yield to 9. Oh boy, I cannot get that right. PE ratio. And it's had dividend growth for the last 7 years, and it's sitting below 60% payout ratio. Its price to book value is 2.25, which is lower than 3.0, but higher than 1.5. But definitely want to take a look here over the last 10 years. It looks pretty standard for this one to have a 2.2% book value, and its revenue, net income, and free cash flow is very positive. So dividend yield 1.96 to around 1.91. They pay out 88 cents per share for the entire year. So if you multiply 22 cents by 4, you get 88 cents for the entire year for each share. Their payout ratio is very low at 27.8. Dividend growth for the last 7 years. Their annualized dividend growth is roughly 4.76%. And number 5, we have PAG. This is the Penske Auto Group. It is the second largest auto retailer in the US and the only public company with a meaningful international presence, primarily in the UK, run and controlled by one of the auto industry's most successful entrepreneurs, Roger Penske. The company's growth is driven by concentration on winning non-Detroit auto brands, investment in additional service capacity, and acquisitions. So their ex-dividend date is on the 9th of February. Again, Friday. You would need to buy this one on Thursday. So if there's an ex-dividend date, I didn't say it earlier, if it's on Friday, you must buy it the day prior to be actually holding it on the ex-dividend date pre-market hours. If you are now holding it when pre-market hours open, you're not going to be eligible for that dividend payout on the payout date, which is the 1st of March. So let's just kind of review very quickly here. If you would like to own Tompkins, which is ex-dividend on Monday, you would need to buy it Friday after hours or before. Intel ex-dividend date is Tuesday, so you would need to buy this one on Monday after hours or before on Monday. Thursday, you would have to buy it Wednesday after hours or prior. And then we have Briarmar Bank, which is Friday. You would have to buy it Thursday after hours or prior to be holding it on Friday. And then of course we've already talked about this one. So Penske Automotive Group, you can see they're very nicely up on 119% revenue year over year, or over the last 10 years. I love they're up around 11%, averaging every single year, and their net income is up 348%, or around 34% year over year. Their free cash flow is down 23.8. This is the one I had looked into. They use a lot of their free cash flow for acquisitions. It even says it right here that they're trying to expand and do a lot of investments in service capability, capacities, and acquisitions. So that's where a lot of their free cash flow goes. They try and acquire small little businesses that are doing what they do, automotive. So that's where a lot of their free cash flow goes based off what I had read. So they pay out 33 cents every single quarter, and this company looks like it increases its dividend quarter after quarter. I'll actually show you this here in just a minute. They're currently priced at $52.87. Their price to book value is at a 12.41. Its dividend yield is 2.38% right now. Its price to book is at a 2.1. So POG, when charted, it does show the current stock is a higher price to yield, which would indicate it may be overvalued at this time. The stock is under in the industry price earnings average, below 60% payout ratio, has had dividend growth for the last 7 years. Its price to book value is at 2.18, which is lower than 3.0, where value investors would consider a value. So their PE is at a 12.5, 12.41, compared to the industry is 18.4. Their payout ratio, or their dividend yield, is 2.58 right now because they just increased their dividend again this quarter, and they increased it last quarter and the quarter before that. They're currently paying out $1.36 per share, but they'll probably increase it an additional 3% the next quarter. Their payout ratio right now is at 31.6. Their dividend growth, they have had dividend growth for the last 7 years, and they increase their dividend by around 3% every single quarter, or 3 by 4 is 12% over the year. And that is it for this article. So those are the 5 stocks for you guys. Again, number 1, we had Tompkins Financial, ticker symbol TMP. Number 2, we had Intel, ticker symbol INTC. Number 3, we had Salisbury Bancorp, ticker symbol SAL. Number 4, we had ticker symbol BMTC, Bryan Mall Bank Corporation. And number 5, we had POG, the Penske Automotive Group. So if I had to pick one, I wouldn't go with the top one, I don't believe. It looks like a great long-term buy and hold. I would definitely want to look up, where their free cash flow is going, but I kind of really like the automotive one. It's some sector I don't have this industry in my portfolio, so it's definitely kind of interesting, kind of reading into it a little bit. I thought it was kind of fun. Their dividend yield is increasing quarter after quarter. If we go over to dividend.com, which is where I pull a lot of this information from, and you just look up PAG, and you can see here their annualized payout is very low, 31.6. Their ex-dividend is again next Friday. If you head right down here to the bottom, they did cut their dividend back in 2008 for around 2009 to 2011. So they completely cut their dividend out for 3 years, and then they came back and they started increasing it quarter after quarter. You can see that steady increase of a cent, a cent, a cent. So they recently increased it from 33 cents to 34 cents. So every single quarter they seem to be increasing it by a cent. So that's at 3% you're going to be getting every single quarter. So it's a nice little buy and hold until the next recession, where they probably may end up cutting that stock. They did a stock split back in 2006, continued to pay out the dividend, but could not afford to pay out during the recession, so they cut it back. The second stock I would consider is probably that first one, which is TMP, and we take in TMP ticker here. Yeah, dividend growth last 32 years. If we scroll down, take a look at their dividend history, you can see that they have a ginormous history of paying out dividends back from 1996, so well over 20 years showing, but 33 years of just continued dividend increases year over year. And their stock price here has been very nice. You can see even during the recessions, this company took a hit right here after, back in 2009. It looks like it fell, but it recovered in a few years later, but they continued to pay out dividends. So it definitely looks like a very nice long-term buy and hold stock, and that would be Tompkins Financial. So if I had to pick one, I would probably actually end up picking Tompkins Financial just for that reliability. And then I definitely want to look at their 10Ks over the last 5 years, 6 years, to kind of get a history of where their free cash flow has been going and what kind of acquisitions and what have they been getting into. So that is it for this video. If you guys have found it fun and entertaining, go ahead and hit the like button below. If you're brand new to my channel, go ahead and hit the subscribe button, hit the notification. I release a scheduled video every Monday, Wednesday, and Saturday, and then I throw videos out every other, here and there, when I have some sort of announcement or some sort of interesting article to kind of cover. I set out videos in between on those days, so go ahead and subscribe for that. And let's see here, that is basically it. So again, I want to thank everyone for watching up until this point. If you have any questions about anything that was covered, go ahead and leave them in the comment section below. If you just would like to say hello, go ahead and leave that in the comments below. I always reply to your guys' comments. As a friendly disclaimer, I'm not a financial advisor or tax professional, and the information provided is my opinion for entertainment and fun. This is not investment advice. This is just me as a financial investor trying to help others make their money work for them. So I post a lot of articles and make a lot of videos. If you guys do have any questions you would like me to cover, leave them in the comments. I will make a video on it. I have a whole little notepad written down with a whole bunch of ideas. So thank you guys for watching. I will see you next time. Have a great day. Bye.